Okay.
Hello, everyone.
Hi, Christina.
Hello, Christina.
Good afternoon, Christina.
Hello.
We have a quorum.
Yeah, but we're just confirming whether we're live or not. So give me another minute. Okay, we are live. I got Martell coming in. So we are good whenever anybody wants to get going.
All right. Welcome, everyone. I would like to call the investment meeting to order for November 17th, 2022. Roll call, please, Sue.
Angela Banks, Christina Bennett,
Present.
Lewis Cross,
Present.
Sheila Goodwin, Donna Jones, Yvette Levy, Martell Mann,
Present.
Bobby Richardson, Albert Sanders, Justin Stein,
Present.
Doris Walker.
Present.
All right, so we do have 5, so we have enough for a quorum.
Great. I would like to continue with the agenda and hand over the presentation to Anco. So let's see which one's going to present today, Guelda or Jeff.
Jeff gets to do the September report.
Yeah, I get to start. So
Oh, great.
we leave the good stuff for Guelda at the end. So we have the full quarterly report. If you recall, at the last meeting we had the flash report. So I think everybody got a general idea, and I know we spent some time talking a little bit about the environment. So I don't want to spend too much time on that. I'm just going to hit some highlights in the full quarterly report. And as everybody knows, some of the major differences, sometimes we have some preliminary numbers for managers and those get updated. But probably the most important thing that ends up coming into these quarterly reports are some of our compliance aspects. So we're looking at the MWDB brokerage. Those numbers get updated for the quarter, as well as our watch list items. So we'll touch on those, but also the rankings. So we generally don't have those in the flash reports, but once the quarterlies come around, we do get the rankings. And that's if there's a positive light from some things that came out of the quarter, and certainly in the longer term numbers through the quarter, we know the numbers aren't fantastic on an absolute basis, but at least from a ranking and benchmark perspective, they've been good. So I'll probably jump around a little bit. Sue, if you want to flip over to page 12 of the report, or if you're going by PDF pages, I think it'll be PDF 13. So this will be the asset allocation at the end of the quarter. And again, this really will look very similar to what we saw in the flash report. So not much changes based on some of the different valuations. So still top line, you see in the large cap equity still a little bit underweight. The other small micro cap category a little bit overweight. So net when you look at all of your U.S. equities, you're going to be pretty close to your target range. International equity is a little bit underweight. Emerging markets, and that's the developed international. Emerging, you're about almost spot on. Slightly overweight in global equity. Core fixed income, that's going to be a little bit lower, but still within that tolerable bound. And again, to refresh everyone's memory on how that top chart works. So again, the upside down triangle, that's the actual allocation. That's where the plan was at the end of the quarter. The black line that you see, that vertical line, that's the actual target. That's where we preferably want to be. And then the gray area, that's our tolerable range. So when we start to get outside of those ranges or close to the edges one way or another, whether it's low or high, we're always looking to rebalance or thinking about how we're going to rebalance back to that middle line. So again, we don't start to get those alarm bells until we get outside of that. In the one where you see we're starting to, or we have been above, and that's hedge funds. And again, we talked about that at the last meeting, just due to the nature of how often we can get money out, which is every quarter, and then we have to give them a certain amount of notice. Sometimes that takes a few quarters until we can actually get that back into compliance. But ultimately, the action necessary to do that has occurred, and it's in motion. And so we're making those steps towards bringing that asset class back into compliance. The other one that stands out a bit, and we're going to talk a little bit more about this in the coming meetings, because we're going to be presenting a pacing study, but you see real estate is now getting close to the top end of that range. And a couple of things have happened there. Number one, just on a absolute return basis, in this tough environment we've had, where all of the other asset classes, equity and fixed income, haven't done well, that's brought those asset classes down as a total percentage of the total portfolio. And real estate has had really strong absolute returns. And so it's been sort of a double whammy of the other asset classes not doing well, real estate doing very well. And so that's allocation started to get up towards the top of the range. So why I mention that with respect to the pacing studies, if you factor in the last couple of new additions that were completed based on the NEPC recommendations for new real estate managers, and what has already been in place with UBS, that when we go through the pacing study, and you'll see it in more detail, that there's really not a lot of additional activity right now that needs to be done as far as funding new real estate managers. So the only other thing that we're going to see is the number one, when the equity markets and fixed income markets do rebound, and again, I'll let Gwilda talk about that rebound, because we've started to see a little bit of that, but that's going to organically bring that real estate allocation back a little bit. And then recall, we made the recommendation for pulling out the one piece of the UBS, one of the UBS funds. So again, that's going to take a while before we get that money back, but that's also going to serve as a way to start bringing that allocation closer to the target. But again, sort of the long story short, and don't want to take away from our message, because we're going to have more to talk about when we show the pacing study. But I think just the sneak preview of that is we're probably not going to have a whole lot of manager search activity going on in real estate. Really, where our focus is going to be will be on private equity. And again, you can see from private equity, we're still not far below our target, but it's always that's why we look at these pacing studies to determine what we expect to be coming back over time, the next couple of years. Where do we think we're going to be relative to that vertical line, and do we have to think about new fundings and searches? So that's what that tells us. And then private debt also, that's one where we're probably going to sooner rather than later have to deal with some search activity to think about some fundings and getting closer to that target. Questions, comments on the allocations? Okay, why don't we jump forward to page 16, or PDF page 17.
I'm sorry, Jeff, did you say private equity?
Yes.
What category of private equity?
Well, actually, that's sort of twofold. So private equity and private debt. Now private equity, again, you see that we're not too far off of our target, and we expect with some of the current managers in place, as they continue to call capital, there's probably not a whole lot, I think, that might need to be prioritized just from the private equity managers, because of what might still be expected to be called from capital and other distributions and things that will be in the mix. It's probably not going to move that needle too much, but again, we're probably going to want to think about the next 1 to 2 years of what we might fund to keep us near that target. But I think private debt is what I mentioned. We're probably is going to be our priority that hits the soonest as far as potential search activity. Just because if you recall, when we made our portfolio recommendations a few meetings ago, part of that recommendation that was approved was increasing that private debt target. So we're below that, and so we will need some outlays with some new managers to get us closer to that target. Okay, so PDF page 17. So this is our the quarterly brokerage MWDBE brokerage update, and so those numbers are from where we looked at a couple of quarters ago. In particular, TCW was one that we were focusing on because they were below, and they've made some pretty concerted moves to increase that number, and they've made the statement to us that they will be there. They should be in compliance with that by the end of the year. So we'll certainly keep an eye on that to make sure they're hitting the target. Westfield's just about there. Systematics over. Edgar Lomax is over on the international side. Causeway well above their expectation. Their Ernest is also. Exponents a bit over, but they are there on the fixed income side. And then for the Exponents global equity requirement, they're also over. So the one that we want to talk about, and again, I'll come back to this because we're going to have a little bit more of a discussion about Intech and our recommendations there, but they've done a bit more. So you see them at that 12% level, but all indication at this point, at least with our discussions, is what we're probably not going to see them meet that 33.3% minimum. So I think we've discussed that, and that's again an ongoing decision that they have to think about internally about how they might do that. But I think all expectation at this point is that they're not going to get there. So something we'll want to think about when we discuss Intech in a bit here. Any questions on the brokerage goals? Okay, Sue, we want to jump forward to page 26 PDF. Okay, and so again, I know we talked a bit about the managers and their performance for the year through September at the last meeting. So I'm not going to spend a lot of time here other than just focusing on, I need to move my box here because I can't see. Okay, so we're focusing on the top line, and I did talk about ranks before. So a couple of things that do stand out for the full quarter and fiscal year and in 1 year periods, and then we'll talk about the longer term as well. But you can see relative performance has been good. Again, I know it's hard to feel good about relative performance or beating a benchmark when the numbers are negative, but we've done that, and that just goes to show that when designing a portfolio, we have several goals in mind. Certainly, it's to meet that actuarial assumption over time, but to also do it without taking on undue risk, and also have the ability to protect capital in these nasty down markets like we've had. And I think this fiscal year number certainly tells a good story. So again, it's down just shy of 16%, but relative to that policy index, which is down a little over 17%. And then if you look at all public plans that are greater than $1 billion at 18%. So relative to a couple of different groupings in there, that's some pretty solid protection of capital on the downside. And certainly we expect that when markets rebound, that we're also having a good amount of participation on the upside. So that's the kind of balance we like. And those are the things we certainly like to see play out over time as we've done some of the restructuring over the past couple of quarters, and things that we looked at and right sized and said, let's get rid of some of these undue risks, and let's make sure we're getting paid for the risks that we are taking on. So again, it's probably a short time period to fully evaluate, but I think it's off to at least a good start from a relative perspective. And again, Gwelda's going to talk about how much better those numbers have been over the past couple of weeks. So from a 1 year perspective, negative 13%, 3 years at just about 3.8%. And both of those returns are above median within the universe. So that's good. And that's certainly for even longer term numbers where we want to be. So on the 5 and 10 year, those are still below median in the universe. So we want to see those come up. And again, with some of the restructuring and the things that we've looked at for this portfolio and how we've dealt with the overall risk structure, we certainly expect as we go through time that 5 and 10 year number, as far as a ranking perspective, is going to improve. And then you can see from relative to the benchmark, those numbers on the 5 and 10 year are still ahead of the benchmark. So some positive things to think about in there. The recent magnitude of the underperformance, unfortunately, has pulled those 5 and 10 year absolute figures down below the return assumption. But again, short-term numbers tend to do that, and we know we can get whipsawed. And at the end of the day, it's what we would expect a pretty strong rebound coming out of this drawdown that we've had. And when those things start to average out, we still have a high degree of confidence that this is a portfolio that gives us a 7% plus return over time. So again, at this point in time, those longer term numbers have come down a bit, but that shouldn't take away our focus from the fact that this is an appropriate asset allocation structure and asset class structure and manager structure today that we believe has that very good probability of getting us that return assumption over time. Questions or comments on the performance?
No comment.
Okay, let's fast forward, and I'm going to skip a bit here to page 83. I'm sorry, PDF page 84. And I just wanted to spend a few seconds on the private equity, the private markets portfolios and the composites. So we do these on a separate page because relative to what we just looked at for the total fund performance and the liquid strategies where these things have more short-term identifiable rates of returns that we can look at, the private portfolios we look at a little bit differently to determine what sort of success we have in the portfolio. And so this table sort of goes through the metrics. Sue, can you scroll up a little bit so I can see the titles on the columns? Good. So all the way to the left, you can see the vintage year. And so those are the years that we first started investing in each of these portfolios. And then you can see the names of all of the different partnerships directly to the left. We can see what our total commitment to each manager is. That's the capital commitment. Then the remaining commitment, so that's the amount of money that's yet to be called. The drawdown, that's actually the amount of money that has been called and then distributed. That's money that's actually the manager's liquidated or has made some money back, and they've now given that back to the plan. So that's always a good number, and we like to see that number grow over time. And certainly the more money we can get back relative to what was initially invested, that makes for a better investment. And then the market value, that's whatever is still invested, what the manager is telling us that the remaining investment amount is currently worth. The IRR, that's an internal rate of return. So again, I liken that to what we saw on those previous pages as the long-term return, or what we would expect if we're invested in these portfolios for a longer period of time, and why we calculate this a little bit differently than what we saw for our liquid equity managers and fixed income managers is due to the nature of how these investments work, and it's because they're lumpy. So when a large amount of capital is called and maybe invested for only a small period of time, and then a big piece of capital comes back in a very short period of time, that type of lumpy activity for investments, it really throws off the math of how a standard rate of return calculation works. Very different from if we take a mutual fund, we know what it's worth today, we know what it's worth tomorrow, and we can calculate the difference. It's a real easy calculation. That just the lumpiness of cash flows for private equity and private debt and real estate partnerships make that calculation a little different. So we sort of adjust for that and try to take out the timing of cash flows, and that's what translates into this number that we call an IRR. And so when we look at those, it's certainly the greater that number, the better. And there tends to be no, unfortunately, there's no particular guidepost, and the best guidepost generally will be if you look at funds that have the same vintage year, start in the same year, we can look at them together. So that's certainly one way we can do it. Others, and I'm not going to jump too much into the TVPI multiple or that KSPME multiple, but just to give a little idea on those are multiples that say that the higher that multiple is, starting from 0 and going up, the better. And that's just it's how much on our original investment. You can think of it how many times our original investment are we making back. So the greater that number, the better. The KSPME all the way to the right, that actually likens each strategy to a similar liquid market benchmark. So if you think of something like a Fort Washington and say, well, what if they were actually an equity manager and they put their $4 million, or I'm sorry, what was drawn down there for Fort Washington, if they put their $10 million to work in the Russell 2000, which is sort of a like liquid small cap index, how would that investment done in the Russell 2000 relative to how it's actually done in their fund? And that's what that multiple tells us. So if that multiple is above 1, that says they actually did better by putting it to work in their strategy relative to putting it to work in a liquid index. So again, we try to be apples to apples for each strategy relative to the index we're looking at. But again, what we tend to look at, because we know private equity and private debt, a lot of them can have ups and downs in different periods and zig and zag. And that's why we like to have a lot of them so they can diversify each other. So when we think about a total portfolio, we like to look at the top gray lines and say, as a group, how is everything doing? And so if we go all the way to the top and look at all of our private markets, so that's our private equity, private debt, real estate all together, and you look at some of the multiples, well, number one, the IRR, that's a double-digit IRR, and that's great because, again, if you think about what our primary objective is, and that's getting that actuarial return assumption. So having an asset class that contributes double digits to a single-digit return assumption is really good. So this is a great contributor to that total return, just from that internal rate of return perspective. And then if you think about the multiples, again, top line. And I'll focus on that KS-PME because that's the one that says, would our money have been better off if each of these guys were invested in a liquid market index? And if that top line says we're above 1, then as a group, we have done better. So we've added value by being in a private structure relative to comparable public markets. So And then as you go down to the sub pieces, we still see the same story. So private equity as a group, IRR of just shy of 11%, a market relative to, a multiple relative to public markets of 1.1 for private debt. The IRR is still at 11%, very, very attractive. And then that multiple all the way to the right is a little bit higher. So it's 1.3 times. And then on real estate, that IRR is 18%. So again, a very solid internal rate of return and contribution to that total fund return over time. And then that multiple again is still above 1. So all of these are positive things and the things that we like to see in a very well diversified private portfolio. Questions? Okay, let's back up a couple of pages to, or actually just 2 pages to PDF page 82. And this is our quantitative watch list. And again, to refresh everyone's memory on how this works. So by the way that our investment policy statement is written is that the 2 columns to the left, manager has failed to meet the index return for 4 consecutive quarters. And then the one next to that has failed to meet the peer group median for 4 quarters. So those 2 are a group. And then next to that are the managers failed to meet index rolling return for 2 and has failed to meet the rolling median for 2. So if there's a fail on both of either one of those categories, the 4 consecutive quarter category or the 2 category, that will flag us. And now certainly if you're missing all 4 of those, that's kind of the double flag. So if you're only missing 1 of each, it's not going to get flagged. So as you can see, as we go down the ones that are being flagged, recommended for watch, Intech, so they're not meeting the both of the 2-year criteria, so the benchmark and the peer group for the 2-year period. TCW is across the board, so they're missing the 4 consecutive quarters and the rolling 2 years for all categories. So that flags them as well. You see Westfield below that's only missing 1, so they're not meeting the median for the rolling 2 years. So that does not get them flagged because they're only missing 1. Fidelity is actually not meeting the 2-year criteria, so that has flagged them. Invesco in the same situation. Going down to Exponents on the fixed income side, they're missing 3 out of the 4, but it's the 2 all the way to the left, the 4 consecutive quarter criteria that they're missing that's flagging them, and then Neuberger Berman is missing the both the 2-year rolling criteria, so that's flagging them as well. So let's I guess think about this in perspective of, but from a quantitative basis, this really tells us that all of these managers should be on watch, and so technically they are. So certainly we want to keep an eye on all of these and determine if there's more underlying problems here other than just temporary issues in the market and things that ultimately we would expect will come back and can be rectified. And I would tell you from the standpoint of at least Invesco and Neuberger, they both had good quarters, and more recent numbers have been improving. Fidelity, we're still keeping an eye on a bit. The Exponents product, recall that in addition to performance issues, they had a portfolio manager issue, so they for us still remain on a very heightened watch. And then TCW, again, we've had them on watch not only from a quantitative perspective, but also due to the brokerage aspect. So again, certainly something we want to keep an eye on. But I think for any of those at this point, we don't have any hard recommendations today, other than we're continuing to keep an eye on it. For TCW, certainly we want to see them meet that brokerage requirement. We are keeping an eye on their portfolio from a performance perspective again, and we'll talk about this a little bit more because we're going to talk about Intech and the large cap growth space in particular. But that's been a real hard space for pretty much every active manager, and the primary reason behind that being there's been a handful of names, and really it comes down to almost two names in the large cap growth universe, and that's Apple and Microsoft that represent the largest portion of that large cap growth index. And so for the past several quarters, whatever has gone on with Microsoft and Apple, however they have performed, has impacted relative performance of a lot of active managers. So if an active manager has had the same weight or a higher weight in those names, when those have done well, then that manager has done well. If the manager has said, well, we want to be very conscious of our risk control and we don't want to have 10% of our portfolio in any one name, they will be underweight Apple and Microsoft. And for the past year, those names have done particularly well relative to the rest of the universe. And so being underweight has really hurt a lot of managers. So it's that positioning relative to a more concentrated benchmark that's really been a factor, again, not only for TCW, but for a lot of other active managers. And so again, I want to put that out there as context, because that's going to be an important factor that says if we look to replace managers within the large cap growth space today, we're not sure there's any active managers that do it a whole lot better right now than someone like TCW, and we're just sort of replacing it with another manager that's facing some of the other issues. So Intech, a little bit of a different story, just because it is quantitative and how they position their portfolio. And I know we've talked about this before. It's almost index plus their strategy. So they're not taking large positions or concentrations one way or another, and their performance over time is almost mirroring index, but it actually has fallen short. So on a lot of different metrics, we look at it and say, if we can't find active managers that can do a lot better, is there potentially a rationale for indexing that portion of the market for the time being? And certainly, as we talk about it today, that's really our overall feeling, at least with the Intech allocation, that we've got enough reasons that we have an active manager, we're paying them a fee, but really for something that's index plus and we're not getting that plus on the strategy, we've continued to have the issue with the brokerage mandate, with the manager also throw in some organizational changes. So a number of things that have been in the works, and then also just the quantitative watch item that continues to be flagged here. So our overall recommendation today is going to be to look to replace that Intech exposure with a large cap growth index exposure. So I'll pause there for discussion and see what everybody's thoughts are on that, and any questions about the large cap growth space in index. And we did submit a large cap growth equity, a U.S. large cap growth equity search, and we can go through that as well and give a recommendation if everybody's on board with the thoughts about Intech.
So Jeff, I had to take another call really quick. Are you saying that we should look down the road for a more passive?
I guess not down the road. I think we're saying we brought a search today. We can walk everybody through it, and if everybody is sort of agrees with the rationale, we would recommend replacing that Intech with indexed exposure, with low cost index exposure.
So on the domestic equity side, but what would that do for? So they don't do They don't do minority brokerage, do they?
Intech or the index?
The index.
The index does not.
So we would have to make sure that we understand that would be an exception and excluded from the policy.
Correct.
Okay. I just wanted to make sure that everybody's aware of that.
Yeah, that is a good point that you bring up, because that is sort of a give up. So it's, and again, I think we have to keep that in the context of again, for us to recommend, well, let's stick with an active manager because we can get the brokerage mandate met. We'd rather wait towards let's get the best performance we can get, which today we think is through an index for that category.
No. I totally agree with you, and I'm forward, but I just wanted everybody to know that so it doesn't pop up on a list in the future, that's kind of noted as a footnote. If we do move forward, that it's a footnote and that it was approved on such and such date. So I just, for longevity, institutionalization of knowledge, I just want to make sure that we know that.
Right. That's a great point, Christina. And I think it's also good to have that for the record. And I guess I'd also throw into that mix too, that I know we've had that requirement for separate account managers, because that's always a challenge for any commingled fund, just because they can't operate with separate mandates. And again, Gwilda, correct me if I'm wrong, but as we're going through this too, the exposure we would have for whichever index manager that we're recommending would either be a mutual fund or a commingled fund.
That's correct.
Let's move forward.
Okay, well, good. So that's, if there's no other questions on the quarterly report, why don't we jump over to the search?
Yeah, Jeff, let's move forward.
Okay, great. Sue, do you want to pull up the index search?
Yep.
Okay, so this is a U.S. Large Cap Growth Index Fund search, and I'll sort of preface this with that this is going through one of these is a lot easier than going through an active manager search, because again, with active managers, we would take a look at what's their investment process, what's their philosophy, how are they trying to beat the index, what's their risk control, and all sorts of other factors. And with index searches, the question becomes a little bit easier. It's is it a high quality institutional asset management? Do they have significant scale and run things as an institutional asset manager should? How well do they replicate the index, and do they have tracking error from the index, and what's their cost for doing it? So again, an index, all they're trying to do is replicate an index. They're not trying to beat it, so they're not selecting individual stocks, so it's not as research intensive. So with that said, we're not paying a lot of analysts to go out and talk to companies and figure out the edge and select stocks and risk manage and all these other things. So it should be a lot cheaper. So, and we'll see that as we'll go through this of what the costs are. So Sue, why don't we flip forward to the first page? And so here we've just outlined the groups that we're taking a look at here. So BNY Mellon, and it's their large cap growth stock index fund. And all of these funds are essentially going to track the Russell 1000 growth. So that's the large cap growth index and the benchmark. And that's a commingled fund. So you see vehicle where it says CIT, it's a commingled investment trust. So very similar to a mutual fund, it aggregates everyone's money. The only difference is that it's not listed on an exchange. So it's a private vehicle, but it still operates with the same sort of liquidity as a mutual fund, and also, as you can see from the fees, operates with a fairly low fee. So relative to the asset size that we're looking to replace here for Mellon, they have a tiered schedule, but this allocation would fall into the first tier, so it would be a 0.03% fee. You see the next group is Fidelity, again, another large reputable provider of index products. That would be through a mutual fund, and that's at 0.035%. And then Vanguard, again, probably one of the most recognizable names in indexing. And I guess I'll qualify the Vanguard a little bit. I don't think they're technically a 1,000 growth. They use another subset of providers to create their indices, but they're going to track pretty close to a Russell 1000 growth, but it's still going to give the same type of exposure, and you see where they're priced at, so they're 0.04%. So from a fee perspective, these are all very much in line. And again, these are from an investment vehicle standpoint and fee standpoint, these are all going to be the lowest share classes available that we can get for each of these respective providers. And again, with where we do see a mutual fund through Fidelity, Vanguard, no other strings attached to these. There's no front end loads, no back end loads, no excessive fees. It's the 0.035 and the 0.04. And the same goes for the BNY product. That is the only fee that you're going to see on that product. Let's jump forward a page, Sue. Okay, so we can take a look at just some of the metrics. And again, we won't dive too much into these, but we can get an understanding of what these providers are looking to replicate here. And you can see relative to the indices. And I guess what always stands out is I know all of these products, and you look at a Russell 1000 and they say, hey, why is it called the Russell 1000? It only has 500 positions, but these are sort of things that change over time with how index constituents are built and what actually constitutes an index, and they more often focus on the valuation spectrum, value versus growth, relative to just trying to keep an even split in the number of names in an index. So that's why you can see that fluctuate a bit. And Vanguard, we would say, well, how come they're a lot lower on the number of positions? And again, that just comes down to how they replicate. So again, they may not own every single position in an index, but they'll sort of quantitatively match characteristics to try to be as close in line with a particular index as possible. And a lot of that's just done from the standpoint of index constituents can change a lot and very frequently. And these managers, if they're always trying to change every single thing in their portfolio to match an index change, it creates more transaction costs relative to a structure where they can replicate and quantitatively be pretty close. So, and as we get to some of the numbers again, you'll see that all of them track the specific index pretty well. So you can see just right below that in the next characteristic section, average market cap. So again, those are in line with what we would expect for the large cap space. So being at 200, almost 270 or close to 300 billion as an average market cap for large cap stocks. Again, you can see other metrics, price earnings, price book. Again, all of those should really be close to in line with the index. So we will see some differences here and there, just based again on certain position sizes and how well they replicate. So we'll see some deviations, but again, it all factors down to bottom line performance that we'll get to in a moment. From a sector perspective, again, right below that, we shouldn't expect to see any major differences in sectors relative to each of these products and where they are versus the index that they're looking to track. So flip forward one more page. Okay. I don't know why Mellon did not make this page. Maybe we'll have to check. I apologize. We don't have the Mellon characteristics on here.
Yeah, and they
Unless-
weren't on this page either.
Yeah, unless they're, I thought they might have been on the next page. I apologize for missing that.
Yeah, I'm looking and I'm seeing it's in the latter part of the report for whatever reason. I don't know why they're not in the front.
Okay, well, I apologize for that. We'll get the Mellon numbers updated in here. But again, I think from the standpoint of any of these characteristics we're looking at, they're all going to be very similar to what we're seeing here within the index. So, and again, from the perspective of regions, here, remember, this is a U.S. large cap growth. So as we would expect, we're going to have the largest percentage here in the U.S. It should be almost 100%. And honestly, I have to ask our research group why we actually have those little residual amounts in the UK. Other than that, might be there could be a specific company within the growth universe that spins off a unit, and for a temporary basis until indices get reconstituted, it might translate into having that little stub piece that sits there in the United Kingdom. So, but for all intent and purposes, this should be 100% in the United States equity market. I'll flip forward one page. Okay, this is style again. Won't spend too much time on here, but as we would expect, these should all be in that large cap growth category. And again, on the left has the current holdings and sort of a range, and then the chart to the right is sort of a historical floating picture of the style over time. But and again, all the way at the top of that grid, that's large cap, and then all the way down to small cap, and then from left to right is value, all the way over to growth. So as we would expect for a large cap growth strategy, everything should be fairly consistent in that top right box. Next page, Sue. Okay, so here's probably the important numbers to focus on, and these are the tracking. And so the one thing I will point out, because I mentioned it before, is that Vanguard, and this is something that's happened over the past several years. So Vanguard, who's always been one of the lowest cost providers and has the largest amount of indexed assets in the industry, they've always had deals with their index providers because in order to replicate an index, someone has to create the index, and then the manager has to license that. Over time, those index providers have sort of taken advantage of Vanguard and said, well, we sort of have you by the scruff of the neck because you've got all these assets, and now we're going to raise our fees and our licensing fees. So Vanguard said, well, you can do that, but let's see if we can find a way around that. So Vanguard actually over the past several years has gone out and found other index providers. And the one in particular is CRSP. It's called CRSP, and they're actually affiliated with the University of Chicago. And they create their own indices. And so that's now who Vanguard will license their indices from. And you will see there's some differences. So, and again, it doesn't always hold that if you look at a 5-year period, the index that Vanguard is tracking is actually done a little bit below what the actual Russell 1000 and then the BNY and Fidelity have done. So if we're looking just to specifically track a Russell 1000, Vanguard's going to be a bit different. Now, there will be periods that might change in reverse. So you might see a period where Vanguard's doing a bit better than the others, and during the 1000 because their index construction will be a little bit different. But certainly over time, when you start to go out towards a 10-year period, you see it comes a little bit more in line. But again, it's just something to be aware of, that they are tracking a different index, and so will perform a bit differently than the others. So, but again, just focusing on the other two that track directly the 1000 growth, BNY and Fidelity, both very much in line with the index. If you look at the 6-year period where we have data for both of them, just pretty much spot on the index, so tracking appropriately. And then as we go out further in time, we only have the BNY numbers. There's no track record going out that far for this Fidelity product. But again, we would expect that tracks just as close as the BNY product does for those longer periods. Okay, if you want to flip forward one, Sue. That's just annual. This is going to sort of tell us the same picture. Again, on an annual basis, all of these are tracking pretty close, so nothing major to point out here. Flip forward one more. These are correlations. Again, we should expect all of these to be pretty close to 1, and that's when we talk about correlation, that just means each manager's returns should be lockstep with each other over time. So again, that just means they're tracking the index close and they're tracking each other close. So again, all of those should be right on 1 up in that top section. Next page, Sue. Okay, risk reward. Again, the middle. Again, how to read this? It's risk is on the horizontal axis, and that's just the volatility of the returns over time, and then the actual annualized return for each of those 3, 5, 7, and 10-year periods is on the left vertical axis, and the lines that you see in the blue box, that's the actual index. And so again, what we're doing here is looking to replicate the index, and for that circle that's pretty close to the index real, the major deviation from that is going to be just a bit of tracking error and fees. But again, from a risk reward perspective, there's no reason that any of these products should have a different risk or a materially different risk and reward profile relative to the index, other than just some minor tracking error and fees. And I think that's about it. There's a few more pages that just go into some risk statistics. Again, I think just from a point of proof that all of these statistics that you see from a risk standpoint, and I guess no matter how you slice and dice risk and other measures, they all should be pretty spot on with the Russell 1000 growth, because again, that's really the index we're looking to replicate, again with the minor differences that we talked about in Vanguard structure, because they are technically tracking a different index. So I'll pause there and see if there's any questions, and then I can sum up.
I want to know why Guelda didn't present like these 3 great managers.
Because she gets the awesome report that's about to come. So.
I get to give you some positive news.
That's a good thing. I thought these managers are pretty good. Again, Vanguard, probably you stacked them properly. I didn't get to see what this compared to what we currently have.
As far as relative to
returns,
Intech,
like
you mean?
Returns, yeah, Intech.
Yeah, I mean, probably the best. Sue, if you want to put the quarterly report back up.
Okay.
Because Christina, probably an easy way to think about that would just be to look at Intech relative to their benchmark, which is the 1000 growth. So let's go, Sue, maybe back to page 26, I think it would be.
Wait, go back. There. Oh, hold on.
Let's see, Intech might be on the next page. I'm sorry.
There they are.
Okay, so we have Intech, and then you can see where they are for the quarter. So they actually did outperform a little bit for the quarter, but you can see on the fiscal year period, down close to 4 percentage points behind the benchmark. Similar on the 1 year, and then as we go out further in time, on a 5-year basis, behind about 2 percentage points, and
Can't take the call right now.
down about a percentage point on the 10-year period. So again, if you think about how they're positioned, and if we said, well, they're really taking a big active bet on things, and we expect that because they're taking bigger active bets, we would expect a large magnitude of outperformance in a different environment. We're just not confident that we would see that. So we look at it and say they're really index plus the way that they're positioned and in sizing and taking on sector exposures and other things. And if we're going to be index plus, that over time we would expect to see a little bit of value added here. But I think just given the strategy, how it's structured, and then the additional layer of fees relative to an index product, it's caused that longer term underperformance.
So the benchmark is the same? Or is it
Correct.
2000? Oh, it is. Okay.
The Russell 1000 growth,
The Russell
correct.
1000. So, okay, so obviously it's really between Fidelity and Bank Mellon, right? Because
right. And our
Vanguard is too far down.
recommendation just at this point is that since the fee is competitive, you currently have an indexed structure and a contract with Mellon, that probably is going to make the most sense, would be to have Mellon do this. There's also an added benefit on there that I believe Mellon should be able to handle the transition on this as well, from an active management portfolio over to their index structure.
Okay, so, all right. So it's 17.3 roughly million.
Correct.
Okay. All righty. Anybody have any questions? So, hearing none, is there a motion to,
Yeah, I have something I can put up.
okay, thanks, Sue. Sue, you're by yourself in the conference room. Why aren't you in your office?
I have a little more room down here to spread out, so
Oh, okay.
a little easier.
I just thought you might have lost your readers or something.
No, no.
All right. Would anybody like to make the motion if there are no questions on the presentations?
Is Martell ready? Is he still on with us?
Hmm?
Is Martell still on with us?
Yeah, and Albert, they're both there.
I saw
Okay,
you,
well.
Albert. You disappeared on me.
I turned off. What was I down?
You breaking up, Al. Go ahead, Al. You're breaking up.
Which one are we recommending?
Mellon.
I
Mellon?
can't make the motion there. Mellon, can you hear me now?
Yes.
Large.
Okay. I make a motion after listening to the investment to select Mellon as the large cap growth manager as recommended by ANCO.
Is there a second?
I second. Second.
Been properly moved in second. Any discussion? Hearing none, roll call, Sue.
Angela Banks,
Yeah.
Christina Bennett,
Yes.
Lewis Cross,
Yes.
Sheila Goodwin,
She said yes, but we can't hear her. But
Yeah,
shaking
she's
her
nodding her
yes.
head.
okay. Martell Mann,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Justin Stein,
Yes.
Doris Walker.
Yes.
So we do have 9, so the motion carries.
I apologize. I was on mute when Christina asked for discussion, because I wanted to make sure to clarify too. And Sue, I don't know if you want to do it as a separate motion, but as part of that, the recommendation would be retaining Mellon and replacing Intech.
Okay,
So Albert, would you like to amend your motion?
Hmm.
You're breaking up, Al.
Replace intake.
You're breaking up, Al. Couldn't hear you.
Come off video and see if it helps.
Okay, hold on. Now I'm tripping. Hold on, I can see that. Hold on. It's that new phone stuff. Can y'all hear me now?
A
Yes.
little better. A little better.
Hey, hold on. Are we better now?
Still a little better. You're still kind of gravelly, but go ahead.
I'd like to amend my motion to state that we're going to replace Intech with Melon as we're going to replace Intech with Melon for our large cap growth manager as recommended by Intech. And we're going to retain Melon as a replacement for Intech for our large cap growth manager.
Did you get that, Sue?
I got it.
And also note that this manager will be excluded from the minority brokerage calculations.
Is that added to the amendment or is that just?
Yes, Albert, can you add that to the amendment, please? Alberto, where'd you go?
He does not look to be here anymore.
No, I think
Not
he's
yellow
having phone
anymore.
problems. He's having phone problems. Is that it?
That's them new phones.
Yep.
Well, we'll proceed and then we can make another motion if needed.
Okay.
Chris, you gonna second it again?
I second.
So do you need another roll call?
Let's do just to be
Sure.
on the safe side. So Angela Banks?
Yeah.
Christina Bennett?
Yes.
Lewis Cross?
Yes.
Sheila Goodwin?
Yeah, she's nodding
Yes.
her head.
Okay.
Yeah.
Martell Mann?
Yes.
Bobby Richardson?
Yes.
Albert Sanders?
Yes.
Justin Stein?
Yes.
Doris Walker?
Yes.
Okay, so again, we have 9.
Okay. And Sue, do we need a roll call if we make a motion and approve by consensus to add Mellon to as an exception footnote on our minority brokerage firm?
Was that not part of this motion?
Albert went off in Never Never Land. No.
Okay. So if we want to do that, that would be a separate motion. We have to do a roll call for that.
Okay. So I'd like to make a motion to exclude Mellon as our large cap manager from the minority brokerage reporting calculations and footnoted.
Second.
And properly moved in second. Any discussion? Hearing none. Roll call, please.
Angela Banks?
Yes.
Christina Bennett?
Yes.
Lewis Cross?
Yes.
Sheila Goodwin?
Yes. He's nodding her head again. Mhm.
Martell Mann?
Yes.
Bobby Richardson?
Yes.
Albert Sanders?
Yes.
Justin Stein?
Yes.
Doris Walker?
Yes.
All right, so again, we have 9, the motion carries.
Do we have anything else? Oh, Gwalda has something on the agenda. Yes, Gwalda, please proceed.
Okay, Sue, if you could bring up the button. Okay, I will just go over a few points. Go to the next page. Just a few comments on the market in the month of October. As you can see here, that second column there that has the returns of the different market segments of the market. In the month of October, you see positive numbers with the exception of the emerging markets index in the equity portion. As you can see here, there was a nice rebound. The Russell 2000, representing small cap stocks in the United States, had 11% return, followed by the Russell 1000 value, the 10.25% return. But everything's positive with the exception of the emerging markets for the month of October. If you look down below, you'll see there that's the fixed income markets, with the aggregate being the broadest of those in the fixed income segment bond market. It's still negative. As you know, interest rates continue to go up, and that has hurt the bond markets. It's an inverse relationship. As interest rates go up, the value of the bond portfolios drop. The only place that was positive there was the U.S. corporate high yield market. If you go down a little bit further on the page, you'll see the sector returns, not unexpected. Year to date, energy still holding as the largest return over time as far as economic sectors are concerned. So fortunately, we have seen a little of a rebound after having a really, really ugly year-to-date returns. As you can see there for the indices, the top on year-to-date basis, everything, equities and fixed income were all negative, no place to really hide. If you go to the next page, this is the chart that Jeff spent some time on with respect to the asset allocation and targets. Pretty much not much different from what we saw before, but we did see some moving a little bit over target actually in the small and micro cap area. As I mentioned on the previous page, small cap did rebound, so you see some increases there. The total global equity is over. We still have ground to make up or to get back to target for core fixed income. And as the market continues to, the markets continue to improve, we'll see these move closer to targets. And then Jeff already talked about some of the alternative areas. The one thing I will say here is the market value actually increased. If you remember from the report a few minutes ago, the market value as of the end of September was $754,259,181. You've gained back some money here. Now at the end of October, the market value is $774,013,403. So we're slowly starting to pull back, you bring back some increases back in, and hopefully November we'll see continued increases in the market value to make up some of the losses we've seen earlier in the year. Turn to the next page, page 3. Here we see a positive number. I get to report positive. So for the month of October, the return of the fund was positive 3.59, which exceeded the policy index, which only returned 3.14. As you look down the page here, you can see total domestic equity actually exceeded the Russell 3000, which represents large, mid, and small cap domestic stocks, 9.78 versus 8.2. The real winner here was in Edgar Lomax. Your large cap value manager exceeded the Russell 1000 value with a return of 12.2 versus the index return of 10.25. Still some weakness in Intech and TCW in the large cap growth. So what really pulled that large cap equity component above the policy was your large cap value manager. Mm-hmm. If you go to the next page, we've got small mid cap. As you can see here, amongst the small and mid cap managers, the manager that actually did the best was your micro cap manager, DFA, 12.61 versus 11.0. Slightly under for Systematic, Russell 2000 value manager, and Westfield had the all these numbers are positive, but not as positive as the Russell 2000 growth, which was the most positive segment of domestic equity markets, but still value add in that segment of about 10.8% for the month of October. And if you look down at international, Both your international managers actually did well in the month of October, with Fidelity returning 6.04 versus their custom benchmark of 4.32. Causeway, a value bent to that manager, 7.07 versus 6.45, rounding out the total international with a return of 6.58 versus a custom benchmark of 2.99. So good value add there amongst your international managers. Now, if you go down to emerging markets, as you remember on the first page, emerging was the one segment that had negative returns in the month of October. But on a relative basis, DFA and Invesco outperformed their respective benchmarks. So DFA returning a negative 0.87 versus the benchmark of negative 3.1, and Invesco negative 0.196 versus negative 3.1, to round out that segment return of a negative 1.38 versus a negative 3.10. That being said, your active managers are actually protecting you on the downside when their respective indices are not performing well. Next page. This is the Exponent's portfolio. As you can see here, Exponent's also exceeded in their the global equity custom benchmark with a return of 6.57 versus 6.03. Next page. We're looking at core fixed income. As you remember from the first page, fixed income had negative returns with the increase in interest rates. Slightly off here, negative 1.39 versus the Bloomberg aggregate negative 1.30. Both of your managers, Manulife and Ernest Partners, missed the mark versus the index, but not significantly so. But both of them missed the mark versus the Bloomberg aggregate in the month of October. Going to the opportunistic fixed income managers. As you can see here, the total is slightly positive, 0.08 versus a negative for the benchmark of negative 0.56. Loomis added value, the Neuberger Berman added value, Lazard fell short, and Exponent's added value. So only one manager there did not outperform their respective benchmark for the opportunistic fixed income, which brought that return more positive than for the Bloomberg Global Multiverse. And I think the next page is it realist? No, okay, Global Asset Allocation Manager. PIMCO All Asset Fund did really well in the month of October, delivering outperformance of 3.40 versus 0.92. For the PIMCO All Asset Index. And in the total hedge fund area, you had some underperformance there, relative underperformance there, as a total of negative 0.27 versus 1.47. The Grosvenor portfolio underperformed, which is the largest component there largest allocation there in that total hedge fund segment. But what I will say about the hedge fund segment, if you look at the fiscal year to date and the 1 year number, and if you look at the longer term numbers for that segment, the managers have actually collectively done a good job in that hedge fund space. And I think the next page is real estate, which of course does not report on a monthly basis. So fortunately, I was able to bring you some positive numbers this time. And on a relative basis, your portfolio is doing well. Collectively, all the managers are doing a pretty good job in what has been a market rebound in the month of October. Hoping that November and December hold up, and hopefully we can pull positive return out of the fourth quarter, but that's remains to be seen. We've got the elections that pretty much are done, so that noise should be gone, but we still have the issue of inflation and some other issues geopolitically, et cetera, that we're challenged with. So keep our fingers crossed that things will continue on a positive trajectory. Any questions or discussion on the flash report for October?
I would like to say thank you for that report, and I'm happy to see all the positive.
Amen.
Thank you.
Amen. Amen.
Yeah. Oh, yeah.
And I think too, sorry, I was taking some calls. Did we get a market update of where we think the next quarter is going to be? Um, everybody's talking a slow crawl into recession, but we'll see what the Fed does for another, maybe 25 or 50 basis points to increase rates.
Yeah, that has been the discussion amongst economists, is that we will probably see another rate hike, which will not bode well for fixed income, and it will create uneasiness for the equity markets. The one good positive factor is that employment is still holding up. The unemployment numbers are still low. We've got a lot of negative noise out there that makes the markets a little nervous. Those are my comments. I don't know if Jeff wanted to add anything to that or not.
Yeah, I think to this point, certainly why the inflation number came in a little bit in October, but I think there was more behind the October rally than just that marginal improvement. I think that was just a more recognition of the valuations were good. We've had a big sell-off and a lot of participants coming back into the market. And November's rally thus far has really been more the factor of the inflation number did come in and the expectation that's going to come in even more meaningful over the next couple of months. However, a number of the Fed governors have remained pretty steadfast in that we still need to see a much more meaningful improvement before they start to pull off those rate hikes. So I think the market at this point is still pricing in at the next meeting. It's probably going to be another 0.75% unless we see some different data in the meantime that leads them to go in lower than that at the 50 basis point mark. So market still thinks it's going to be 0.75. I also saw an interesting comment from Fed Governor Bullard today too, that his expectation on the terminal rate was 5 to 7%. So 7% short-term interest rates. That would be interesting if we got that far. So I think we certainly see this next one, whether it's 0.75 or a half, and then have to get through the holidays. But I think after the holiday spending gets by and we get that, we look at what the hangover effect is, and in particular with how much rates have gone up, a couple of things happen after the holiday season, and that's everybody gets their credit card bill, and that's going to be.
Did you not see what Jeff Bezos said? He's laying people off because he doesn't think people are going to be buying this holiday, and to warn people to not buy big products, because you might not be able to pay for them come the credit card bill time.
Yeah, it as much as he gives out that warning, I think the sentiment at this point is we're probably still going to see some pretty healthy holiday spending for better or for worse, but that does translate into first quarter, we see those credit card bills and what that means. And certainly we've seen what that has meant in the short term on the housing market, because now those mortgage rates are at 7% plus and going up. And so that's certainly a factor for the housing market. And what has been an ATM for a lot of people out there is just their house values and kind of using that home equity as another ATM. So as we start to see that normalize, that's just another factor that, as Gwelda said, creates more of this uncertainty and ongoing volatility in the markets. But as long as the earnings have remained solid, and we would expect some growth in those jobs numbers, if those can remain steady, then the Fed might be able to do the favorable dance of getting us that soft landing. So
I was going to say, they're not trying to do the salsa, they're trying to do waltz.
Yeah, it is. And I would, if you're at 4% inflation trying to get to a soft landing is a lot easier. when you're at 8, 8 plus or wherever we topped out at 9 and trying to get down to 2, soft landings are hard, and that's a real management process, and I wouldn't want to be sitting in their seats. So.
Do you have anything else on the agenda?
That's all we had.
looks like you must have the background filter because you both are not sitting in the same office.
No, we're not. He's in Chicago. I'm in Metro Atlanta.
So is there anything else on our agenda, Sue?
There is not.
Louis, do you have anything?
No, I don't have anything related to the investments. I'm glad to see things kind of turning around, and you all are doing an excellent job. And I just want to wish everybody a very happy holiday and a happy Thanksgiving.
Likewise.
Likewise, yeah.
Happy Thanksgiving to everybody.
Thanks.
Hope everybody's
Happy Thanksgiving.
Have a safe and happy Thanksgiving.
safe and
Yes.
happy and
Can I get a
great times
motion
with
to
your families.
adjourn?
I make a motion, we adjourn.
Oh,
Richardson,
thank you,
second.
Hey,
All right.
All right.
All those in
Yeah.
favor?
All right, bye,
Thank you,
everybody.
everyone.
Bye.
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 Done. Thank you. All
okay. See you later, Jess.
right, see you.
All right.
Bye.
See y'all.